It is October 1907, and the United States has no central bank to stop a financial meltdown. It begins when speculators try to corner United Copper stock, the bet collapses, and the rumors spread like wildfire. The real weak spot is the trust companies, huge deposit takers that held smaller cash buffers than banks and sat outside key safety nets. Depositors sprint to withdraw, and Knickerbocker Trust gets hit so hard that it suspends operations, turning fear into full panic. Wall Street then chokes because the call money market freezes, and overnight borrowing rates spike to extreme levels. Here is the scary part. The New York Stock Exchange was close to shutting because brokers could not get cash to settle trades. With no lender of last resort, the country's emergency plan becomes one private banker, J.P. Morgan, age 70, acting like a one-man central bank. He orders rapid balance sheet checks to separate who is merely illiquid from who is actually insolvent. He pulls rival bankers and trust leaders into his library and pressures them to commit rescue money on the spot. Banks and clearinghouse groups create emergency credit tools, and the system even restricts cash withdrawals to slow the run. The United States Treasury also steps in by shifting government deposits and pushing liquidity where it is needed most. A final flashpoint comes when a major brokerage looks ready to fail, and a last-minute deal is arranged to prevent another wave of collapses. When the panic finally breaks, the country realizes something brutal. It cannot keep outsourcing national financial stability to a private meeting room. That is why the crisis sparks reforms that lead directly to the creation of the Federal Reserve in 1913. So the panic of 1907 is not a conspiracy story. It is the moment America learned that confidence needs a system, not a savior.